It is something we all have to do. It is our taxes, and this would be the time where it would have been great if I brought a controller for the prompter. Oh well. See, the new year has greeted taxpayers with Obamacare penalties, Obamacare tax credits, and an assortment of other changes as well. Here to help sort us through, me and my prompter problems, CPA Bob Martin and Barbara Walker Green with PersonalWealthAdvisor.com. Thank you very much for coming in. I appreciate it.
Thank you for having me.
So, Bob, let me start with you and the Affordable Care Act as well. It affects people this year. It affects people next year. Changes keep coming seemingly on a day-to-day basis.
There's a tremendous amount of confusion. If you're filing your tax return for last year, you're filing it now, then you are not affected by the penalties under Obamacare. However, and the credits that you might get also, that will affect you next April 15th. But it's things that you do now, for example. If you do not get adequate health insurance that qualifies under the law, then if you don't get that by the end of March,
March 31st, yeah.
March 31st, you will be subject to the penalty. And also, if you qualify for credits, you're going to have to decide. They have credits. If you're low income, for example, it'll reduce your premium. You have to decide whether you're going to take the credit in advance against those premiums or you're going to wait and take the credit on your tax return next year.
Decisions that people have to make. Barbara, what a couple of groups that are going to be affected by the changes this year and next? Who do we have to look out for?
Well, two groups that I'm noticing, especially coming into my office, are same-sex couple and high-income earners.
Okay.
Same-sex couples historically were filing single, and now they have to file married. Those same-sex couples who are married, and then the high-income earners, the high tax rate went up to as much as what, 39.6%, Bob?
Yes.
Yes, that's very high. So when we counsel our clients, we tell them we have to look at all your prospective streams of income. How are you going to be receiving it, to see if maybe some of that income should be tax deferred income versus income you're paying taxes on in the current year.
Bob, medical deductions have changed to some degree. How?
Yeah, on the returns that people are filing now, for example, if you're under 65, the floor has been raised to 10%. And what I mean by the floor is there's a certain amount you can't deduct, a base amount, which used to be 7.5% of your income. It's going to be 10% if you're under 65.
So for people who itemize, is that essentially a 2.5% tax increase for them?
Well, no, not tax increase,
Right.
just loss of deduction.
Well,
so it'd be a little less than that.
I was trying to use a little bit of Washington mathematics in there. So, Barbara, who do you think these things have the biggest impact on?
I would say the high income earners, because of the higher amount of taxes, the lower amount of deductions you can take. That floor has been reduced in the previous times. Some of them worry about estate taxes that potentially could go up. So the main thing is really to get the guidance you need to really sort out how you should be holding your assets. Maybe you should reallocate assets maybe to something more tax friendly.
Something for everybody to worry about.
Something for everyone.
Yeah. Barbara Walker and Bob Martin, thanks very much for the wisdom this morning. We appreciate it.